On today's show, just two questions. Number one, what's the deal with SpaceX? And number two, is cash filling too safe?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 Cents, where we help Dennis navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Back again. People need to know, Rabih, we are recording this early. We have just a weekend in between the last recording and today. We're recording this on Monday, which is very abnormal for us. Tell the good people why, Rabih. Tell the good people why we're recording this on Monday.
We are recording this on Monday because Thursday, Friday, and Saturday, usually not Saturday, but usually the times when we usually record, Matt, myself, the whole DA team, all of our valuable customers, friends, partners are going to be in Midway, Utah at the Dentist Money Summit. Isn't that
you nailed it
enough of a reason?
You freaking nailed that. It's like you literally had that like written down, but it just came from your brain. Yeah, that is exactly right. So if you're listening to this and not at the summit, I'm sorry, guys, it's too late. You missed it. We are, Rabih and I are going to be wowing people on the stage. No, we are recording this on Monday because of the summit. We wanted to get this out. So we say this with the caveat of, if things happen this week that we don't cover on this recording, that's why. We're recording it on Monday. You said we were going to talk maybe Iran war today, but it's like things are changing by the hour. So by the time this actually gets released, there's really no point because there'd be so much that happens.
I'm working on a breaking news website where it sends people notifications by the minute because this is how it feels like. Stuff are evolving really quickly. But if we want to like zoom out, the war has been going on for like 2 months. We do not expect it to be resolved for another 2 months. Like the longer it stays, the longer it'll take to resolve, unfortunately.
Yeah.
But a lot is changing in the details.
Well, and it's unfortunate too, because it's really difficult to believe anything that's being said on any side because just as of a couple of weeks ago, there was all these articles about, we're close to resolution, negotiations are happening. And that was coming out of the, administration's like, press releases like, we're close. And then within hours, it was like, nope, we're going to take our time. And bombing started again. It's been a mess. So we're not going to talk about Iran because there's, again, too much evolving and changing by what seems like the minute or the hour. So let's talk. We've done this, Rabih, because you listen to us as you're putting your head down on the pillow at night when you're not here, or you're devouring some incredible meal in China, you were listening to us. So we talked about SpaceX a couple of weeks ago, but I'm glad you're back on because now you can give your perspective specifically around SpaceX and what's happening. We're getting a lot of questions about this one. This feels like we talked about this a couple weeks ago, but it's kind of like the IPO front's been pretty quiet, at least from like people asking us for the last little bit. This feels like the biggest one in a while. It's, and from a market cap perspective, it's the biggest one ever. So we're getting a lot of questions. There's a lot of news about it. So let's talk about it, Rabih. What is the deal with SpaceX? What's your perspective on it?
My perspective, I'm actually going to complement what you guys talked about. So I listened to the podcast and you guys handled IPOs and talked about historical returns of IPOs and how because of like insiders, they usually do not promise the money for retail investors like they usually do. And we're all on board. This is our investment philosophy. I am here to scratch the itch for some of those who send us emails, who are asking about stuff, about whether we should be investing in it. And I'm like, sure, let's go through that exercise. I'm going to put on my analyst hat on. I'm going to dissect the company, look at it, and tell you what we think. And then you can make your own decision on whether you should invest in it or not. It's some interesting stuff has been happening in SpaceX as a company, because it's a company that owns so many companies. You guys hinted at it, but I got you the numbers. So if we look at SpaceX as a company itself, it has, I would say, 4 main branches. Okay, there's the launch service branch, which is what we know SpaceX for. Has like the Falcon 9 and the Starships, and they send stuff to space, and they work with NASA as their customer. That is one. The second one is Starlink. which, the internet, residential internet, internet that's used for maritime, aviation, enterprise, as well as for government and spyware, right? That is SpaceX, the Starlink part of the business. There's also more of like, I would call it defense related stuff for SpaceX. It's crew mission, cargo missions. This is different than the Falcon 9 because the Falcon 9 is also trying to be space tourism. That's what competes with Jeff Bezos. And then the big one is AI and social media. So earlier this year, SpaceX bought XAI. XAI, that happened in February. XAI is another Elon Musk company. And XAI as a company owns, let's guess what, X, which is Twitter, and Grok. And Grok is just like a ChatGPT where there's subscription and it makes money. So SpaceX as a company has, I would say, three main different businesses. The Falcon 9 commercial businesses and defense stuff with NASA. It has Starlink, which is the satellites. And then it has XAI, which includes Twitter. We're just going to call it Twitter for people to, and Grok, the AI model. These three combined, or 4 branches combined, are going to be posted on the market for a market value of $1.75 trillion. So my question would be here as an analyst, okay, I can't decide whether SpaceX as a big label is 1.75, but I can look at each one of these three and see what is the value of these, and let's add it up together, okay? This is the data that I have. The first thing is, the launch space part of it. The revenue for that in 2025 was around $4 billion. It's not really disclosed. The data we get from these is from the NASA contracts because NASA is a government agency. There's a segment of the business that makes $4 billion. Okay, cool. How does that as a business segment grow and evolve? Well, unfortunately, not just SpaceX, any company that only works with the government, where the government is its main client, you do not project revenue and growth the same way you would do with a company that deals with consumers, that can be incentivized by new products, that can follow a hype, that they would want to upgrade. The way you make money from a government is that the government sets a budget, usually puts us into the deficit, and then you just have to live with that budget that is set. So there's no revenue projection on that side. The government contract is the government contract. You don't have leverage over the government to actually squeeze out more money out of their pocket. So that was the first portion. The second portion is Starlink and connectivity. That did around, I would say, 11 billion in revenue. So if we add the 4 billion from the space stuff with the government and Starlink, which is the satellites connectivity, we're at 15 billion. This is a very profitable part of SpaceX. It has 11 billion of revenue, but it also makes 4 billion of income. This is where the income of SpaceX comes from.
It's Starlink.
Starlink. The satellites make money. Airlines, operate with them. Government agencies, other corporations all use that, 24 hours around the globe internet to collect data from satellites. So kinda the crown jewel of SpaceX is Starlink. And then the last one is Grok and Twitter. We know how much Twitter used to make money before it went, back into the private markets owned by Elon. But as of the latest details on Twitter is that it only made 3 billion in revenue. So if we add the whole total revenue of SpaceX, it's 18 billion, 11 from Starlink, 4 from the launching and space, and 3 from Twitter and Grok. But in terms of the income, it's losing $6 billion a year. $6 billion a year. So SpaceX as a whole is not profitable. Is not profitable. Mainly because Twitter and Grok are just bleeding cash like crazy, like all other AI and social media kind of companies where they depend on advertising in this changing age. So this is the company. I'm telling you, it's a company that makes $18 billion in revenue. It has a segment that's profitable called Starlink. It has a segment that's terrible, which is Twitter and Grok. $18 billion of revenue. We are saying we're going to put it on the market at a valuation of, what did we say? 1.7 trillion. $1.75 trillion. This means that the price to sales multiple is 94x. You're paying 94 times the amount of sales that it makes just to own a piece of that company.
It's crazy.
As an analyst trying to look at it, I feel like this is expensive, right?
Yeah.
Very expensive.
Very expensive. Yep.
The other point around this 195 is like, where do I put that benchmark? I'm just going to give you a benchmark of companies that had what their price to sale multiple, like how much did you pay for sales for each of these companies. The ones that were more expensive from SpaceX were Rivian and Snowflake. Rivian was in the thousands and Snowflake was 119x. SpaceX is 94x. What is the fate of Rivian and Snowflake as individual companies to buy? Not really. And then other companies that were widely successful return-wise for investors, when they IPO'd, their price to sale multiple was for Facebook 28, Meta, for Tesla 17, for Uber 7, and for Airbnb 14. Those are like the big IPOs that we've heard in the last couple of years. So all the successful companies had valuations price to sales are less than 30. This one is 94 and it's not making any money where some of them were making money.
Yeah.
Another red flag, right? This is how I rank companies and the exercise that we have to do intellectually just to understand, am I getting my money back for what I'm investing in?
Yeah.
The last thing.
Go ahead. No,
please.
Go ahead.
No,
well, I just love the context that you're giving here, because showing that not all, like, there's this hype around IPOs, especially the big name ones, but almost like a DSO offer, right? It's the same thing where it's like not all these are created equal, and we have to really, because I could imagine a dentist out there saying, take Facebook as the example, or any of the other ones you mentioned, and saying, well, look at that, like this could be the next one, just because on its surface it's like big name company run by a very well-known person who's always in the media. There's been movies made about this company, like that kind of thing. It's like, oh, I got to get in on this because look at Facebook. But I love that you're breaking down, like, this still comes back to just fundamentals and the fact that Facebook is not the same thing right now as SpaceX, just fundamentally, to your point of one key metric being price to actual sales or price to actual revenue of the business. They're not even on the same, like in the same ballpark.
No, just looking at these numbers shows you how expensive it is. And one last piece of data about the valuations that actually made me want to talk about it because it was so obnoxious is that I told you earlier in this year, SpaceX bought Twitter, or bought XAI, which owns Twitter. They are both companies for Elon Musk. If you remember a couple of years ago when Elon Musk did this whole fiasco trying to buy Twitter from public shareholders, they agreed on a value for Twitter of $44 billion. Yeah. This is how much Elon had to, I don't know, post as collateral, take a note, liquidate some stocks to buy Twitter itself. When they did this internal transaction in February 2026, where they said, oh, SpaceX is acquiring XAI that owns Twitter, do you know what the value of XAI was?
No.
A couple of years ago, Twitter was valued at $44 billion. He sold it to himself at a valuation of $250 billion.
Whoa.
So next time you decide to buy the shares of SpaceX, remember that you are buying Twitter back at $250 billion, while it's bleeding $6 billion a year.
That is wild. And like you said, he sold it to himself.
Yes. It's just inflated on paper.
Yeah.
So that's the issue with SpaceX. And this is me just putting on the analyst hat, trying to push back with numbers for people who are following the hype.
Yeah.
But do you have anything else before I hit them? I have another counter argument, but do you have anything else about the breakdown of the business?
No, I think it's interesting. I don't, it's issues above my pay grade. What I don't understand entirely is why he wrapped in seemingly a completely different technology and company and brand into this SpaceX brand and company, which again feels completely, I guess I just don't really understand that, why he would do that. And it feels like it'd be a much more valuable company and maybe a better buy if the XAI part of it was not part of it.
Oh, That is a good point. But if he's stuck with it and it's bleeding $6 billion a year, and he found someone to take it off his plate, even if he does some packaging and he merges it with something bigger called
I guess that's what it is. He's hiding it within his bigger, better brand.
Yes.
And I guess that's what it is right there.
That's what it is. And the bigger, better brand is what people are behind SpaceX for. Like the hype we're listening and getting about SpaceX isn't because it's this combination of 3 different companies. No, it's
people don't even know that. They don't even know what's happening with the underlying companies.
Probably. But the reason why are people hyped up about SpaceX? People are hyped up on SpaceX because of the promise that the next stage of AI infrastructure enhancement and capacity building is going to be happening in space, and we need to build data centers in space.
Yeah.
So whenever someone starts throwing science at me to try to prove a point, I sit and watch YouTube for 24 hours straight. This is what I did.
I love it.
I was trying to understand, can we really build data centers in space? Like, what does it take to build? And I actually found a really good a YouTuber who does these stuff, but I also found a big documentary from Wall Street Journal that talks about it. And I would just want to summarize it for you to understand what they're pitching us. Because Elon Musk is really good at pitching us stuff. Tesla, before it just became, a losing EV, a market share losing EV car in the US and around the world, it was this promise that it's going to be a data company that collects all of our driving data and it's going to make autonomous cars everywhere. Well, it's lagging in the market and we were not able to do on that promise. So the promise that's happening with SpaceX is that we're going to be able to build data centers, and they just tell you the science allows it. So and I'm not a scientist, but I try to learn about the science. In summary, what happens is that on Earth, you go out, you find a very big plot of land, you build a data center on it, and the data center will take a huge amount of electricity and will take a huge amount of water to cool down the servers as they are processing the computations within the chips that are made by NVIDIA and made by TSMC, etc. The problem with this economically is that, one, it's taking a lot of land and politically people are not liking it. 2, it's taking too much energy, and we do not have enough energy in this geopolitical environment. We don't have a surplus of energy to just route the electricity to data centers. And the last most important one is that this is taking water, and that is a matter of affecting other industries, whether it was farming or people living in cities.
And also fundamentally, it's not like these data centers are adding to the economy from this aspect of job creation, right?
No, they're just building them, yes, but they're just a big warehouse that is running computation, not to make AI work on your phone or on your computer. On the contrary, your phone and your computer will have their own AI chips within them. These data centers are only to train the big AI model that can then be downloaded on your phone and computer and can live on it locally. So they have I wouldn't say a one-time use, but they have a usage, an initial usage. It's all about just training the new big next thing. But the actual AI that's going to be serving us coffees through automated vending machines or helping us with navigation on our phones, this is going to be calculated internally. It's not going to depend on the electricity and water of the data center. So that's what's happening on Earth. Electricity is a problem. Water is a problem. Let's take it up to space. And there has been an experiment actually where they took out NVIDIA chips to space, and they made like a mini data center and they tried to process it. And they worked very efficiently. That is the promise. That's why people are hyped about it. But what does the physics say? Just for people to have a talking point in their mind whenever someone excited comes and talks to them about it. So what would happen is that you're going to ship out in batches those chips, those components of a data center that isolate the chips from radiation. And also you're going to ship up a big amount of solar panels. Solar panels outside of our ozone layer in the low orbit of Earth are 10 times more efficient than on Earth. So the electricity problem is solved. I'll just ship up a lot of solar panels. They're weightless. They're in space. They'll be all around over there. And I will win a 10x efficiency in collecting electricity. That will make the data center run much faster. That is the whole idea. How much solar panels? Enough to cover 3 football fields. But space is space. You just have to ship them. That is the problem, right? The second problem that will arise is the cooling port. Well, it's very cold up there, but because it's vacuum, heat will be trapped and will not be able to exit those systems or the water or the fluids that you put up in the server. So yes, you're going to get a 10x efficiency in electricity compared to an on-Earth data center, and that will make it economically viable. However, you're going to have a problem with dissipating heat that is much easier on Earth, and with transmitting the information back down to Earth, because that will take latency, etc. And you can't really send a lot of messages out of Earth. Like you see when we talk to astronauts, it's probably with like a 5-6 second delay. So imagine you're trying to download the full OpenAI model or the full AI and send it back down. That will take a long time. So solving the electricity problem will make it economically viable, but it creates 2 other problems, which is heating and data transferability. Will the benefit from electricity efficiency overcome these and still make it economically viable? Well, just because it's not a clear yes, then it's a no. And just the fact that there's a company promising that, yes, it's going to be 10 times more electrically efficient, but we do not know whether that will translate to actual profits, makes me question, why should I jump ship on a hypothesis scientifically?
Yeah.
That is the argument. I rest my case.
I love this, and I see what you did there. You said jump ship, like jump spaceship.
Yes, why not?
I see what you did there. Yeah, I mean, I think, again, you obviously went into far more detail, which is not surprising, and I think it's really helpful. But it just comes back to what we said, and the first time we talked about SpaceX, just fundamentally, a lot of IPOs, and this one doesn't seem to be immune from this, is maybe it's even worse on this one more than any others, is just built on hype and story. And by the way, we're not saying the story is necessarily wrong and that they won't figure out these problems and solve it and everything comes to fruition. It might, but I just think it comes back to fundamental investing principles of, if you're going to mess with something like this, you're going to go jump in and have some fun with it. Okay. I have a client right now who I've been talking to about this. Rabih, you've been a part of my conversations with him. A very, very wealthy person, and it has been really interested in it. And we've talked it out with him and said, hey, great, let's just build some rules around it of like how much you're going to actually put into something like this. And he has. And we're like, yeah, go have some fun. Do it with the mindset of, if this money goes to zero, we're not saying it will, or it doesn't bear out the way you hope and think, it's not going to be catastrophic to your personal financial life. I think that's what this kind of comes back to.
100%. 100%. And when you limit it to that small portion, it's not going to change your life if SpaceX does well, but also it's not going to change your life if it busts.
Yeah.
So that's where we sit. At least now, you know a little bit more about SpaceX, and you're trying to, as an investor, think about this based on information and a bet on whether the technology will take us there, rather than fear of missing out. Just want to make sure that you are not missing the train of momentum. And really, the intention by why you choose to invest is more important than what the outcome might be.
Yeah. So true. Yeah, and what I've told many clients at this point, and many dentists, and we said this on the last one, we talked about this, is like, you're going to get exposure to this kind of stuff anyway. If you're well diversified, if you're following a principle-based investment strategy and a systematic approach, you will get exposure to this stuff.
Yes.
You don't have to chase things to, like, one client in particular was like, well, this might be the next NVIDIA. And I love what you said, Rabih. You're like, no, the next NVIDIA is NVIDIA for a while. Like,
it's going to be NVIDIA for a while.
Still NVIDIA. But you don't have to chase these things and guess which one's going to be the next NVIDIA. You just stick to your system, stick to your strategy, and you don't have to pick the winners. You're gonna get that exposure.
100%. And do you want to know when you'll get exposure depending on the index? I have that data for you.
Yes, this is a good little factoid here. Yeah, hit it.
So, fun fact, whenever a company goes IPO, usually index designers and providers take a little while to vet it before they include it in the index. Because once it's included in the index, it forces all these complete indexing, follow the index type of thing, do not have tracking error. Everyone buys at the same time and messes up the stock market. Everyone sells at the same time and incurs costs that aren't necessary. I'm going to think of like Vanguard. Vanguard is a pure indexing type of company. It's especially inclusion into the index and exclusion out of the index is a big inefficiency that these complete 100% passive funds deal with, and they actually carry over that cost onto clients. So in order to kind of mellow the impact a little bit, out of responsibility, I would say, the companies that design the index that these ETFs track have guidelines on when they would include a company in their index. So for NASDAQ, new listed large companies can be included 15 days after the first trading day. So you might have, if SpaceX chooses to list its stocks on NASDAQ as well, you might have SpaceX exposure 2 weeks from now without you having to buy or sell
anything,
which I do not know if that's a good thing necessarily, right?
Yeah. Yes.
The second thing is the Russell, the FTSE Russell. So that would be like Russell 2000, Russell 3000, etc. They have a very fast entry into eligibility to the IPOs. They include them on the 5th day after the initial trading day. So in 5 days from now, if you're holding the Russell 3000, there are so many ETFs that track it, you'll probably going to have SpaceX. The big one, the elephant in the room, which is the S&P, and that is what includes the S&P 500, 100, 400, etc. They have a rule of 12 months to 6 months. So it would take a year until, SpaceX is included. And that is nicer because usually, and research has shown us that in the first 12 months,
IPOs don't do well.
Actually lose money since they started trading, especially for people who buy it at IPO day. So that would be nice. There is a proposal because the richest man in the world is trying to make this profitable for himself, to reduce that requirement on the S&P and bring it down on par with the rest. But usually for any other normal company that IPOs, it's usually 6 to 12 months. So you will get exposure sooner or later. When you try to go and buy, end of this week, you're not buying to get exposure. You're buying to make a bet that you are by being overexposed than what the normal market is going to get exposure to. And as long as you know the risks, it's all up for grabs.
Yeah, I think it's funny. I think in the short term, there's going to be a lot. Well, I shouldn't say a lot. There's going to be a few people making a lot of money in the initial IPO of this, but it ain't going to be you and me, Rabih, or anyone out there listening.
No, it's those who've had it for 10 years.
Exactly. It's the private people. It's the people who actually own it. It's Elon. It's his team. Like, they're going to make a lot of money. They're incentivized to hype this up. Of course, they're IPOing. This is part of the IPO process. It's not only the ins and outs of the investment bankers and the structure of the deal and all that. It's a PR campaign. That's exactly what it is. It's a PR campaign. They're out there hitting the streets, hitting the media outlets. Of course, they want this to go to the highest possible price as early as possible. But as you said, Rabih, the data shows over the course of a year, IPOs do not do well, even if over the long term they do, like a Facebook or an Uber or whatever. But a lot of times they just do not do well.
They do not do well. And actually, there is a really good piece of research by Dimensional, Dimensional Fund Advisors, which is one of the companies that manage ETFs and mutual funds, but they do not take 100% passive indexing approach like the others that we mentioned. And they published an academic paper. It was like in an academic journal talking about the returns of IPO companies. So companies that IPO for companies that IPO for a year, like between their IPO date and a year of holding, for all the companies within a time period, how much they would have done. So companies between 1992 and 2018, and they break it down by period, but the whole period from 1992 till 2018, companies that IPO, they created a portfolio called companies that IPO, which means whenever a company IPOs, we're going to buy it and we're going to hold it for a year. And after a year, we're going to sell it. And through any time that happens, in the whole period between 1992 and 2018, we're just going to be doing the same. The performance of that portfolio was 6.93% from annualized from 1992 to 2018. If you take the total US stock market, the Russell 3000 index in a sense, on the same period, that did 9.13%.
Wow.
And if you take small caps, which is the Russell 2000 index, that did 9.02%. So IPOs from this study and showed that they underperformed by 3% annualized over a 30-year period. So that's more like double your money. So if there is someone out there who is only buying, their investment strategy is not a globally diversified, low-cost portfolio, but their strategy is that whenever a company IPOs, I'll buy it, hold it for a year, and then sell it. And I do that indefinitely. You probably are leaving so much money on the table. And the fact that people might, be swayed and start acting as if they have a different investment strategy the moment a big name like SpaceX shows up, disrupts that compounding effect. So that the numbers are there for us to reference, fall back on. It's now up to us behaviorally to make sure that we drive the point home and we actually keep those returns to show up.
Love it, Rabih. So I think we've solidified SpaceX, cool company, doing some cool things, might be life-changing or world-changing, maybe universe-changing, but don't get, maybe just pump the brakes a little bit. Pump the brakes on the spaceship a little bit. Anything else you want to add to SpaceX?
I don't think people would want me to add. Like, we went into all the details.
We did.
But if you guys still have questions, we're happy to answer.
We're here. Okay, last thing, because we only have 2 questions today. We're going from SpaceX to cash. We're going from excitement to boring.
Yep.
Boring. But the question being, is cash feeling too safe? I found a couple interesting data points I wanted to hit that I think there's a couple layers to this, but I'll just hit the first layer here. So money market fund assets. So money market funds being, basically think of them like cash assets, really short-term holdings, kind of like a mutual fund, but you're just holding short-term instruments like treasuries and cash equivalent investments. They crossed over. They're just under $7.9 trillion as of last week. So I don't know where that stands contextually. If that's an all-time high or what, but it's a lot of cash. And what it's indicating, according to this article, is that investors are still holding huge amounts of cash, mainly because yields are up. That's kind of the benefit of like the double-edged sword, if you will, of yields being up and interest rates being up. Is it really hurts it really hurts people who are getting loans, a benefit to savers. Yep. So it's kind of a good and bad, a push and pull of the economy when it comes to rates and yields being up. So, but this is a significant sum of cash. I think this is a good chance really quick to talk about one of the underlying or one of the under kind of rated issues we see, Rabih, as you know, is cash drag. When dentists hire us, one of the first initial things we do with them is get them really organized. We build them a balance sheet dashboard. We look at their cash flow, all this. And I don't have a number to this. I'm just going to throw a number out, but I'd say 4 out of 5 of dentists who hire us, I feel like I sound like a commercial. Like 9 out of 10 dentists agree, but I'd say it's probably 4 out of 5 dentists that hire us as we kind of go through that process. I would say they hold too much cash, and we really show that to them, reflect that to them in this organization. And one of the main things we often see too is not only are they holding a ton of cash, they're holding it among all these kind of random scattered accounts. It's like they've collected them like baseball cards, and it's like they just have like 7 cash accounts across their businesses and their personal accounts. So that's the first thing I want to just reference is an underlying issue being holding way too much cash. I want to hit that for a moment and why that's, I'm not going to say bad, but could be detrimental to your overall kind of wealth building journey. Rabih, I want to throw it to you for a second. Any thoughts that you have?
Yes. And we see it as a cash. And I know DA has like its own rule of thumb on cash, but I want you to remind me of them. Like when we say you're holding cash, I'm not saying you should not have cash anywhere. I know we have, like rule of thumbs for a business cash amount, but also what's your rule of thumb for cash in a retirement account? Like, where should cash be held and how much?
Yeah. So absolutely should be holding some amount of cash for sure. What I always tell people is your cash simply needs a job. It needs a job, a definable job within your overall life and strategy. So the two jobs that cash play, number one, easy, is emergency fund. It's a buffer against the unknowable. That's really, as Carl Richards says, the only risk that really matters is everything that's left over when you think you thought of everything else. So there's always going to be some element of like, I don't know what's going to happen here, so you should have some cash. So on the personal side, emergency fund, the job there for that cash, or the amount, would be 3 to 6 months, pretty standard amount. There's context and nuance there. The more liquid you become, let's say like in a brokerage account, and like let's say you're holding 7 figures in a brokerage account, you probably don't need that much cash. 3 to 6 months, you probably can cut that way down, because now you can do things like a pledged asset line, like a line of credit on your account, and get easy access to cash. But generally speaking, 3 to 6 months on the personal side. On the business side, it, again, context matters, but we'd say anywhere from 1.5 up to 3. That's pretty high. Probably kind of a sweet spot would be about 2 months of overhead sitting in cash as a buffer emergency fund. The other reason, the other job to be done with cash would be a definable in scope and timeline investment and or project coming up, either on the personal side or on the business side. So you're remodeling your kitchen, or you're bringing on an associate, or you're investing in some equipment, or you're building out an operatory, whatever, some type of project coming up or investment that you know is happening in a short period of time, anything 2 years or less, absolutely a great reason to hold cash and not expose those dollars to the short-term whims of the markets. But that's pretty much it, Rabih. There's no other reason to be holding cash beyond that, really. You might have another reason.
I was hoping you'd say waiting for the market to crash to buy in.
No,
because we hear that a lot.
Not on the list. Nope, not on the list. So those are really the only two that we ever advocate for. Yeah, this idea of like, I'm going to wait till the market pulls back, or I'm going to wait for this opportunity. That's just a fast track to getting you in trouble. And really hindering your overall growth. So those are the two reasons we ever advocate for holding cash. Beyond that, cash is just literally, we call it cash drag for a reason. And it feels safe. It feels like a nice comfy blanket, because you see the dollars, like, oh yeah, it's like really soothing to see the cash balance. And I get it. I've been there. I totally understand. But Dennis, don't want to realize, or don't necessarily realize what an actual risk and detriment is, the opportunity cost. And people will say, well, you can't really calculate that. No, you absolutely can calculate that. And it is absolutely an actual definable, measurable loss to your wealth, to your net worth, by holding too much cash. And you absolutely can prove the counterfactual over the next 5, 10, 15, 20, 30 years of holding that cash out of the markets and knowing what you could have earned on those dollars elsewhere. So that opportunity cost is very real.
I think a main point that we would talk about with cash and cash drag is the impact in a portfolio, because I see a lot of prospects or clients who are trying to hire us, and most of the time their portfolios have 10 to 15% cash in there, and they think it's part of the business strategy. However, cash is kind of the only security that does not show you when it's winning or it's losing. So when you buy stocks, you see the stocks either going up or down. When you buy the bonds, you see the coupon increasing and slightly incrementally going up. With cash, you have $100,000 sitting in that brokerage account. You're always going to see it as $100,000. But in reality, inflation is playing in the background. Yeah. And in nominal terms, just looking at your portfolio, you'd say like there's no drag on that portfolio. That 100K is staying as 100K the whole time. But if you look at the portfolio after inflation, in real terms, what is happening is that those stocks are going up, those bonds are ticking up a little bit, but then that cash is actually bleeding slowly every single year, a straight line down. So next time you look at your portfolio, imagine we live in a world where you look at your portfolio or your bank account and you see, oh, I have $100,000 of cash in my account. And then you look at it 6 months later. And when you look, instead of saying 100,000, you see probably 990,500. Just 6 months. It's sitting in your bank account. It's like, oh, it's $500 less. And then 6 months later, you look at it again and it's $99,000, not $100,000. Like,
Yep.
oh, there's $1,000 loss just because you're not touching it. This is what cash drag means. In real terms, this cash, just like a car, is a depreciating asset in real terms. It's losing to inflation every single year, every single day. And just the fact that the print or what you're seeing on the screen is stable does not mean it is there out there. And on the long run, that hurts.
Yeah, it does. And if someone's out there listening and they're saying, well, yeah, but all my cash is sitting in a high yield savings account. I'm at least earning something right now, which is true. There's, again, good, better, best. It's better than sitting in a checking account for sure. But we've seen that as well, where dentists are sitting on way too much cash in a checking account. But a dentist might be out there listening and saying, well, I'm at least getting 3.5% right now, my money. That's at least outpacing inflation, or at least matching inflation. True. Totally true. And again, better than sitting in cash or under your mattress. Totally acknowledge that. But if you're sitting on multiple 6 figures, or we've seen 7 figures in cash, way over what you need, and you compare, even in a high yield savings account or a money market fund, and you compare that over the next 5, 10, 15, 20, 30 years of a globally diversified portfolio, again, assuming these dollars don't have the jobs we just highlighted, the difference between even a high yield savings yield right now of 3.5% versus what you're going to get, not a guarantee, of course, like all the disclosures, but if you just said probability wise, from what you're sitting on or what you're getting in that yield of a high yield versus probability what you're going to get over the next 30 years in a diversified portfolio, that is significant. We're talking 7, 8% maybe difference. We're talking multiple 7 figures of difference. And again, I can't emphasize enough, that is real. That's a real loss because it's dollars you could have been putting somewhere else that can be measured versus dollars that you left in cash. This is not a fake theoretical thing. This is a true loss to you. It's big, it's significant, it's life-changing possibly.
It is. And this really brings to mind the idea like there's no free lunch, which is a concept in economics. There's no free lunch.
Yeah.
And in the context of cash and allocating money, this tells you that the markets could be the best thing that happened to us as a society, but also the worst thing that could happen to us as a society.
Yeah.
Because markets force us and hold us accountable. It's reward those that allocate capital efficiently, and markets punish those who do not. And allocating and having cash sitting aside with no job, as you mentioned, especially for a long period of time, it means that you are on the side where the markets are going to punish you for not allocating resources efficiently. Just like Mother Nature, right? You're either growing or progressing, and I don't know, like biologically wise, or you are in decay and you're reaching towards that.
I think I'm in the decay side, possibly.
You can't sit on the sideline with nature, but you can't sit on the sideline with markets. Sitting on the sideline with markets means that you're just in that decay portion. So unless there's a job for that cash, we do not wish that economic decay upon you.
Yeah, we do not wish that. The last thing I wanted to mention on this, Rabih, total shift of gears, but I thought was interesting, and we'll just mention this really quickly. So we've talked, one of the themes of our show over the last several months even has been this kind of like separation of like sentiment versus what's actually happening in markets and economy. And I think this is another data point for that. So what I found interesting when I was doing this research is investors are sitting on a ton of cash, as we highlighted. But another piece of data here around cash on the emergency funds side is Bankrate has a 2026 report that showed that 29% of Americans have more credit card debt than emergency funds, that only 44% of Americans have more emergency fund savings than credit card debt. What I find interesting about that, just as a side note, is another data point that shows what a separation of classes and wealth in America we have right now. Of the people who are investing, and as we've already established, majority of the market is owned by a small percentage of investors. You compare that to like the everyday American who, they're not listening to this show. Dentists are not the everyday American, but they'd be listen to this and be like, What do you mean too much cash? That's like the last thing on my list of problems. There's just such a separation of people who are investing sitting on too much cash, and then again, regular people who are out there with 30% of Americans right now have more have more credit card debt than emergency funds. Like, that's pretty wild. And again, just shows this difference in or this break in sentiment versus what's actually happening out there.
Yep. Wealth inequality is a feature of markets that I said could have been the best thing that happened, but also the worst thing that could happen.
Totally.
And wealth inequality can be measured by what is owned in each strata of the wealth spectrum. And we see it. The wealthier top 20%, I would say, most of their net worth is concentrated in financial assets, followed by real estate and very minimal debt. You go to the middle portion and it's concentrated with real estate, not enough financial assets, and maybe a little bit of debt. Then you drop down to the lower bottom, 20%, and they have zero financial assets, probably a little bit of real estate, but lots of debt. So that mixture as compounding does its magic for 20, 30 years, actually shifts where you stand amongst the pie of American consumers. That is, for some, the American dream, but for others, the American nightmare, right?
Yeah.
So knowing the data and knowing how markets work and knowing the importance of how your money is allocated is very important. I know we started the segment just talking about, hey, cash drag is important to your portfolio. But if we want to try to exaggerate to make the point, how you allocate your resources, including cash, determines your quality of life and socioeconomic standing.
Yeah, so true. Oh, Rabih, only 2 questions, but we yapped. We hit it. Anything else you want to add?
You guys should have been at the summit. We're at the summit right now.
We missed you. If you're listening to this and not at the summit, we missed you. The other thing I'll mention briefly is we have another second cohort of our Launchpad. Really excited about that, starting in September. This is everything you did not learn about money in dental school, and it's going to be an 8-week course taught by mostly our team. Live courses. You're going to have access to a coach, access to our advisor team along the way as well. Be able to build out your own personal financial plan. So we would love to have you. You can go to dentistmoneylaunchpad.com for more and to get the early bird special. Again, I sound like some commercials here today on the show, Rabih. For now, again, we missed you at the summit. Maybe next time. Rabih, thanks for being here and sharing your words of wisdom. Everyone, thanks for listening. That was our 2 cents. Till next time, take care. Bye-bye.